Morning, Jonathan. I'm Monica Young. I'm broker of Just Global Inc. and host of the GLEI Club. You might have heard inflation of October has come down to 7.7%, and that prompted interest rate could go down by 0.5% to 0.625%. So if you're looking for deals, builders are now providing great incentives at this time of the year. Sometimes I've seen more than 100,000 lower in cities like Raleigh, Durham, and Orlando, and some other areas. So if you want to get more details, please reach out to us. At this time of the year, many of us are working on our tax return. I have invited Mr. Jonathan Lee, tax attorney, to provide some more tax saving tips. Jonathan graduated from J.D. Major School of Law in 2005. He is a member of Professional and Bar Association and California Bar Association with a focus on the tax section. So without further ado, may we now invite Jonathan to take over. Thank you, Jonathan.
Hi, everyone. My name's, like Monica said, my name is Jonathan Lee. I am a tax attorney in San Francisco, and I specialize primarily in international taxation, but a lot of times that involves domestic taxation as well. So my hope is that with this conversation that we're about to have, that you may gain some knowledge or tips about what you can do on your personal tax returns in anticipation for the year end to hopefully mitigate tax consequences for you in the upcoming year and possibly future years as well. So how my presentation is going to start is that I'm going to give you a brief update about significant changes in the tax law that went into effect recently, and general tax planning strategies going forward with respect to being especially mindful that the year end is coming, and many of the steps needed to mitigate future taxes actually occurs in this short 2-month period. So without further ado, let's start. So what's to be expected for 2023 with respect to the Inflation Reduction Act of 2022. So the Inflation Reduction Act passed in August. It focuses primarily on environmentally related tax credits and policies designed to address environmental concerns. There are other aspects to it, but most of my focus today will just be on the applicable credits that might be applicable to individuals. So the first and major component of it is the extension of the non-business energy property credit extension. So essentially, previous to this year, you could deduct about 26% of improvements made to your homes or business property that made your home more efficient. So with the thinking and the end result being that your consumption of heating and cooling will be reduced by these improvements. Okay, so this typically involves your installing new windows that are more energy efficient, insulation in your walls, skylights of the sort. With the law does say that for certain improvements, you are capped. So for example, skylights, you are capped at $1,200 per year per taxpayer. So between two spouses, if you spend less than $2,400 on skylights annually, then that amount might be fully deductible. So, or a significant chunk of that will be deductible. The next part that, the next part that we're probably familiar with from prior years is the residential clean energy credit. And this is applicable to your purchases of solar panels, solar hot water heaters, fuel cells. So if you have a Tesla battery of some sort connected to your home, if you own a windmill of some sort on your home, or geothermal heat pumps. In prior years, this credit was limited to 26%, but with this ongoing credit, it actually increases it to 30%. Now, this is subject to state rebates or any rebates you might receive from the manufacturers for purchases of their specific equipment. But this is this is a slight bump up from prior years, and it might make sense for individuals to consider making purchases of more clean energy products and to improve their homes. The next one that we're probably most familiar with is the new Clean Vehicle Credit. Under the prior program, there used to be a manufacturer limitation on the credit itself based on the number of cars sold. So previously, only the first 250,000 cars sold by a manufacturer would qualify for the credit. Under this new program, they removed that limitation altogether. Now, with the caveat that, hey, these cars must be purchased in 2023. And there is the other significant change is that the determination of how the credit is calculated is different from years past. And ongoing, there is a modified adjusted gross income limitation on the credit. So if you earn in excess of $300,000 annually for married taxpayers, you're probably not going to qualify for it. The exemption actually lowers down to $225,000 if you are head of household, or $150,000 if you are a single taxpayer. There is also a MSRP limitation on the vehicles themselves. One second. So under this limitation, so if you are purchasing a SUV, I recently purchased one too. It only applies if the vehicle itself, the MSRP is less than $80,000. This also applies to pickup trucks, sport utility vehicles, etc. Now, for all other cars, so your typical Model S or 3, or I'm blanking on the names of the other brands, but that limitation actually lowers to $55,000 as well. The other consideration in determining whether you could qualify for this new vehicle credit is that it actually comes in two parts. The first part, meaning that the materials for the battery itself must be derived from the United States and constructed in the United States, up to, I believe it's 40%. The second component is that the actual manufacturing of the car itself must be completed in the United States as well, and 40% of it must be manufactured here. This is new, so it does limit your choices or options for specific brands. But if you're going to buy a Tesla, you're probably in the okay. But if you're going to buy a BMW electric car, it might not be. So it's probably important that you check with your dealer to determine if your car would qualify for the credit itself. Okay, so now on to year-end tax planning. So we're in this weird state of the world where we're coming out of the COVID-19 pandemic, and while the economy was looking fairly strong and on a good path of recovery, world events happened. Namely, we have a war ongoing in Ukraine, and as a result of that war, sanctions were placed on Russia, which resulted in an increased energy consumption costs. With the increase in energy consumption costs, and which we're all feeling now, inflation has become something that we're dealing with. On top of that, now we have businesses across the country bracing for lower than expected profits and difficult times ahead. So layoffs are happening. Meta just announced that they were laying off a significant portion of their workforce. We've heard about Twitter. It's affecting a lot of companies, and it's not just industry. It's not just in the technology industry, but it seems to be across all industries across the country. Uh, and as Monica mentioned, while high interest rates are continue to be a thing, the federal government did acknowledge that inflation did seem to slow down um, after its latest after its last meeting. Um, Hopefully, that means that the situation will improve, um, and um, and and hopefully, if it improves, then the economy might not enter into a recession. But based on business and how employers are reacting, I think everyone is anticipating that. So with that being said, this does present an opportunity for tax planning in considering how best to position yourself for the future, and keeping in mind that we're living in this unique circumstances where there's a lot of uncertainty. Let's see here. Okay, so not necessarily related to the Inflation Reduction Act, but uh, uh, President Biden did announce a plan to basically forego or really or student debt relief for certain income for students, and it is eligible up to $20,000 for some borrowers. Now, whether you qualify for this or not, you'll have to probably talk to your own tax advisor. But if you have children who are recent graduates, it might be something to consider, uh, to maybe forego employment if you can, or even defer it until to get below it that certain adjusted gross income level to qualify for this reduction in your actual student debt. Now, the thing to also consider is that, and this is happening in real time, and even after I put together this slide, is that the courts have put a hold on the student debt relief program for now, and the Biden administration, as a result, has stopped taking applications. But this is still ongoing, so we'll have to check in a bit. But assuming that this program will continue or will be allowed to continue, it's something to consider if you, especially if you have recent college graduates or recent students who like me were previously were heavily indebted to our academic institutions. Let's see here. So what's new for individuals in 2022? So many of the tax benefits that were as a result of the prior administration and the incoming administration's tax policies were related directly to address the effects of the COVID-19 pandemic. With the COVID-19 pandemic finally looking like it's about to end, or there's light at the end of the tunnel, many of these programs or tax benefits that we used previously are set to expire. So things to consider. There are expanded health insurance subsidies that were extended through 2025, but consider that both the child tax credit and the dependent care credits are planned to be reverted back to pre-pandemic levels. And just for reference, the child tax credit will revert back to $2,000 as the phase out applies. And the other thing to consider is that the age of a qualifying child will be reduced from 18 to 17. Let's see. Okay. So the other thing to consider is whether or not to get married in 2023 or not. The marriage penalty does exist if you are two high income individuals and you do plan on getting married. It might make sense to put off your wedding until after 2023, until we get more a better idea of where the economy is going to go. If you have two high income individuals getting married, you would be subject to a marriage penalty, which essentially says that it would have been better if you filed separately rather than together as a result of getting married. The other thing to consider is that if you are currently a head of household in your property, in your home, and you are considering marriage, consider taking that or accelerating your income in 2022. And what this basically means is that if you have outstanding accounts receivables or people or income coming in, try to get that recognized in 2022 rather than waiting for the new year. Because as I stated before, if you are a high income individual and you do marry another high income individual, you're going to get hit with the marriage penalty. Okay. So increasing or lowering, oops, I should have gone back there. Increasing or lowering your 2022 AGI. So the typical individuals who should consider increasing. As I said before, if you are a head of household, consider recognizing more income this year if you are planning on getting married in the following year. If you are a student and you are graduating from school, or a training program or paid workforce, you're about to enter into the workforce, increase your income if you can. Once you start working and then you start recognizing income, at that point you will be taxed at a higher rate. If you expect to be eligible for one or more credits next year, like the child tax credit that is subject to phase out, increase your income to qualify for whatever credits that are planned to be phased out in the coming year. And who should decrease? If you are planning on divorcing, decrease your income this year and increase it the following year if you plan on becoming a head of household in the following year. This maximizes the tax benefit to yourself. If you anticipate having lower income in the following year, so if you anticipate being laid off, or if you were recently laid off, try and take as much of that income in 2022 versus in 2023. If you have a child, try to have that child receive income in this year rather than next year when they might not qualify for the child kiddie tax. So for capital gains, if you can, recognize long-term capital gains in the future rather than now. And I've attached an approximate tax chart for 2023 going forward. These numbers have been adjusted for inflation, I believe. The other consideration is that the short-term capital gains will be just taxed as ordinary income brackets going forward. So things to consider with respect to capital gains or losses. As you can tell, if you have a long-term capital gain, and if you believe that amount is going to be less than $459,000, take that now versus later, right? You can do that with special methods, and namely, you could use an installment sale or another means to delay recognition of the income until the following year, such that if you keep the capital gains amount below this 459,000 number, it would behoove you to do that. The same is true if you are married filing jointly or married filing separately. So as I mentioned previously, how you would do this is that you could recognize or defer income through an installment sale. And all that essentially means is that if you are planning on selling an asset that is subject to long-term capital gains treatment, try and have that sale recognized over a 2-year period. So the most common example that I tell clients is that if you're going to sell an asset, a stock or a security or other financial product, try to arrange the sale where you'll receive a certain portion of it on 12/31 and the balance on 1/1. So over the course of 2 days. Doing so essentially just splits it up between the 2 tax years. The other way you can actually defer your gains is make a charitable donation. I mean, if you're going to give Uncle Sam that money, you might as well just donate it to a nonprofit of some sort. The other option is if you do, and as most folks are familiar with already, if you do sell your principal residence, it could qualify up to a $500,000 exclusion based on married individuals, provided that you meet certain requirements, like living in the home for 2 out of the last 3 years or something. You can ask your real estate professional on the specifics of that program.
Can I inject a little comment here?
Sure.
On the gain deferral, one thing you may want to consider is do a like-kind exchange. Okay. Now, they only pertain to real estate that are used in the trade of business, such as rental. Okay. It's a very common strategy used by real estate professionals to defer the gain on the sale by going what they call it the like-kind exchange route. Okay.
Some other considerations to keep in mind are that the wash sale rules and the constructive sales rules. So what the wash sale essentially means is that if you buy or sell a security at a loss, and you reacquire that security or something significantly similar to that within a 61-day period, that loss won't be recognized. So if your intention is to sell some stock because you anticipate utilizing that loss to offset gain somewhere else, keep in mind that you have a 61-day period before you reacquire stock. And related to that is constructive sales or short selling. If you sell a appreciated stock with the anticipation that you believe that the value of that stock or security or asset is going to significantly decrease in the coming months, keep in mind that if you do reacquire something before the 61-day period, it might be considered a short sale and they will require you to recognize the gain. So whereas the wash sale refers back to trying to generate a deferral of or recognition of a loss, the short sale rules specifically apply to recognition of income if you acquire something at if you short sell a security or a other financial asset and require it within that 61-day period. There is a specific rule for installment sales on depreciable property under Section 1231 of the Code. 1231 property is typically assets that you lease out or use for a business purpose. So if you have a rental asset, a home or a business property, a car, or equipment of that sort, typically it would qualify. It would qualify for capital gains treatment unless it is a 1231 property. So if you have a 1231 property that you sell at a loss, that loss is considered an ordinary loss, which means that it's not taxed. It's taxed differently from the sale of a capital asset. as I mentioned before, capital assets, capital sales, are taxed at a different rate and a different structure than ordinary income, which is taxed based on your income levels and your bracket level. So what this could mean is that, look, if you have a loss in a rental property and you take that loss this year, well, that loss constitutes as can be deducted against your ordinary income, meaning that if you have ordinary income from a trade or business from another source, it can be used to offset that income in that sense. With that in consideration, if you already have a loss going into recognized in 2022, you might want to consider deferring any 1231 losses to 2023 if you can. So next, we're dealing with real estate professionals themselves. So if you own significant amounts of real estate, you might want to consider using a S corporation or some kind of entity to hold those assets themselves. And the reason why I say that is that typically, if you have passive income sources from rental and real estate, you can only net losses and income against those passive income sources. But if you do take the step of forming an S corporation to hold that real estate, and you take on the role as a non-passive and a material participant in those activities, you could convert those activities from passive to non-passive, and thus benefit from ordinary or non-ordinary income losses. Standard and itemized deductions. So what's new? There's a temporary suspension of the AGI, adjusted gross income percentage limitations, for charitable deductions, which expired on December 31st, 2021. So you can, in essence, donate more to qualify for higher amounts of deductions. If you are an educator in a classroom, you can now deduct out-of-pocket educator expenses. My sister-in-law is a teacher, so this specifically applies to her. There is also above the line deductions for contributions you make to health savings accounts. Charitable contributions. The charitable contribution amounts have increased, whereas in the past, you could donate, you can write off 50% of your cash contributions, and I believe it was like 25% of your non-cash contributions. So like tangible property, your donations of clothes, on household items and whatnot, used to be capped at 25%. Now it raises up to 30%, and cash, which used to be 50%, now is increased to 60%. The other thing to consider is to use a charitable remainder trust. So this applies when you have a low basis in a stock that has appreciated considerably. Rather than selling that stock and incurring the capital gains treatment on that, you might want to consider using a charitable remainder trust instead. You can make a contribution to that trust, and you can essentially avoid having that capital gains treatment applied to you, while simultaneously benefiting from the charitable contribution as a result. Medical expenses. Now, taxpayers can deduct medical expenses if such expenses exceed 7.5% of AGI. So if you had a medical procedure that occurred in 2022, and if those amounts were quite significant, it might make sense for you to delay recognition of income in 2022 and push any income to 2023, such that you could qualify for a medical expense deduction, assuming that those medical expenses exceed 7.5 of your adjusted gross income. To accelerate medical expenses in 2022, consider getting your prescription eyewear renewed, paid before the year end. If you have any surgeries that you've been putting off, see if you can schedule and get that done before the year end. The earned income tax credit for 2022. The earned income tax credit is determined by the taxpayer's earned income from wages and other sources. So for 22, the maximum earned income credit is $6,935 for those with 3 or more qualifying children. The amount of earned income on which a earned income tax credit will be computed is $7,320 for taxpayers with no qualifying children and $10,980 for taxpayers with 1 qualifying child, and $15,000 for taxpayers with 2 or more qualifying children. So for 2022, the phase out of the allowable earned income tax credit will begin at $15,290 for joint filers with no qualifying children, and at $26,260 for joint filers with 1 or more qualifying children. The amount of disqualified income, which isn't taken into consideration for the credit itself, is $10,300 for 2022. So with that, I'm open for questions.
Okay, Jonathan, may I inject a few comments before we go into the Q&A session? Oh, by the way, my name is Simon Lee. I'm a retired CPA, and I'm also an international tax consultant. One of the issues that we talk about is how to increase income in the year 2022. 2 ideas came into mind. One is you may want to offer a discount to your customer, have them pay early before the end of the year, so we can recognize income in 2022. The second idea is if you have a new business started in 2022, consider using accrual method of accounting. Now, you need to consult your tax advisor before you make the move, okay? Because you select your accounting method when you file your first tax return. So be very careful. It can be a trap too. So check with your accountant about selecting accrual method of accounting. Now on capital losses, unfortunately, a lot of investors incur capital losses in the stock market this year. One idea you may want to think about is to sell the asset. You may have capital gain built in, okay, to offset the loss with the gain. For individual, the amount of capital loss you can deduct in the year is only $3,000. And it's even worse for corporation, which is capital loss are not deductible at all, okay? So you might consider offset capital losses with capital gain assets, okay? All right, I'll go back to you, Jonathan.
Okay, so with that, if there are questions, I'm here to answer them.
Yeah, well, we encourage everybody to type in your questions. I do have a question. When you mentioned about 1231 property, what are the properties considered 1231? Just give us some. Yeah, because you mentioned about in your previous presentation.
Okay, let me touch on that. 1231 asset means depreciable asset used in the trade business. You have 2 subcategories under 1231. One is 1250, which is depreciable real estate asset, and then 1245, which is a depreciable asset used in the trade business other than real estate. So the beauty of 1231 is when you sell the asset at a gain, the gain is taxed as a capital gain, except the depreciation portion, which you need to recapture at 25%. The losses when you sell those assets, the 1231 asset is considered ordinary loss, which is you can use it to offset ordinary income, which is taxed at the highest rate. So 1231 is a very, very advantageous tax code section for depreciable asset used in the trade business. Okay.
Thank you. Yeah, that's very helpful, Simon.
Okay.
So we do have a question from Belle. She's asking, what is the current status of Security Act? So, like, would that have any kind of tax implication? Do you think it's possible to pass?
John?
I'm hesitant to say anything will pass in this month and a half period before the close of or the entrance of this new Congress. I would refrain from commenting on it just because I don't know if there's. I would say that I would think that the likelihood of it passing is probably none. I wouldn't hold my breath.
Okay. Got it. So I have another question. Interesting that sent to me. So Lawrence wants to know, for any income phase-out limit to get credit for solar installation at home, is what else to consider? Because sometimes, like say, maybe you could share with us your perspective about income phase-out limit to get credit for solar installation.
My understanding is that let me go back and check, but I don't believe that there's a limitation on that. Let me solar. I don't believe there is an income requirement for it. I think that it just applies whether.
So no phase-out limit for income.
Yeah.
Oh, I don't think so. Yeah.
I think there was a change, but I'll have to double check on that, the specific numbers of it. If anything, I do believe that if there were any changes, the phase-out limits would have been raised to encourage the use of clean energy products.
Yeah. Okay, that's good to know. So you mentioned that for, say, real estate professional, it's advisable to form an S corporation in holding real estate assets. So then if it is not held in a trust, it's held in an S corporation, what would be the impact if like the owners pass away, and would there be still step-up payments for the beneficiary?
Yes, there would still be a step-up basis for the beneficiary. Essentially, they would be inheriting the equity interest in the S corporation. The thing to consider with an S corporation, and for the purposes of using an S corporation to hold real estate assets, is that you're essentially changing the income and any prospective losses from real estate activities from passive to non-passive. So if you have built-in losses because of depreciated property, well, you're not going to be able to utilize those losses unless against your ordinary income, unless it becomes an active activity, like an active real estate management portfolio.
Okay, Monica, may I inject a little comment here? Yes, I think one thing we wanted to think about is estate planning. The most common tool used in estate planning is the use of living trust, which has tons of benefits and avoid a lot of pitfalls and headaches created by the passing of the loved ones. Okay, like avoidance of probate, things like that. Okay, pay a hefty attorney fee to handle the probate. Seriously consider a living trust as part of the estate planning. Okay.
Yeah. And like I understand you have provided a lot of details regarding the new tax law. So if a taxpayer is considering like planning, do you think actually with the same income or about the same income, the taxes they are going to pay, is it going to be higher in 2023 next year versus if they try to report it this year? So would that be tax increase overall?
Well, the thing to consider is that the actual brackets themselves for taxation will actually increase for 2023 versus 2022. So if you're making $100,000 in 2022 and you're making $100,000 in 2023, you're going to be subject to lower taxes in 2023 simply because of those adjustments that were made in in recognition of the inflationary pressures that we felt over the course of 2022. In terms of the actual brackets themselves, there isn't any change in terms of percentage.
Well, okay, one thing we all need to think about is the inflation pressure on the economy. If the tax rate remains the same compared to 2022 versus 2023, you're better off to collect the cash now versus next year. Consider the time value of money, okay? Because the cash you receive next year will have less value than the cash you receive right now.
Yeah, because of the future value of money, huh? Even if like a rate of 7.7%, yeah, it was less.
For those as old as me, you turn back the clock about 35 years ago when we had double-digit inflation and double-digit unemployment and double-digit interest rate. The best investment to protect your asset was in real estate. Okay. Yeah, seriously. Those were the golden years of real estate in the United States.
Yeah, it certainly hedged against inflation, huh?
Absolutely, yes.
Yes. So I have a number of clients going to be getting into age that they can get the Social Security.
Okay.
So Social Security provide like 8% more for every year. Yeah, the applicant wait. And now with inflation at like 7 to 8% or even 7 to 9%, what is your observation? Whether they should try to apply early or should still rather wait, to get 108 or 116%? What is your observation?
Well, Monica, that's $1 million question.
I asked the expert. At least you just tell us your perspective.
Well, I'm in that category myself. The thing is, there are a lot of things you need to consider. Your family history of health, okay? Your life expectancies, and how you want to enjoy your retirements, okay? And what other financial resources you might have besides Social Security. In my case, I would like to defer until I'm reached the age 70 and a half to collect my Social Security payments. Now, also, there are talks in the Congress right now. They want to repeal the taxation of Social Security benefits. Now, whether they will pass or not, I don't know. Unlikely, but there are talks in the Congress that they want to repeal the taxation of Social Security benefits. Okay, but keep that in mind.
Yeah, that would be helpful because people getting it early, they also get penalized, having to pay tax on that.
Yeah, that's correct. Yeah.
Yeah. So like now the RMD starts at 72, right? So of course it would be up to the individual situation, but like say if the people can afford it, should they kind of wait till the final deadline to start paying those taxes and withdrawing the 401k?
Yeah, but sometimes you don't have a choice. When you reach the age limit, you have to start making RMD. Okay, so yeah, you don't have a choice, unfortunately.
But there are other considerations, like there's casualty in exceptions to the RMD distributions. If you suffered a fire at your home, or if you live in an area that resulted in a natural disaster of some sort, you can withdraw from whether it be your IRA or 401k without incurring the RMD penalty. If you, and it just goes back to what we were talking about before, if you need to recognize income in this year because you anticipate your 2022 income being relatively low, it might make sense to recognize to take a distribution from a retirement account and pay the 10% penalty if your overall tax bracket is going to be much lower. So if we refer back to the income tax bracket charts, if you anticipate your income to be like less than $50,000 annually, or below the minimum threshold of actually having taxation, then it might be something to consider. even if you have to incur that 10% penalty.
Got it. Yes, that's very good. And if any attendees have other questions, you are very welcome to email Jonathan directly to set up a time for a Zoom advisory consultation section, because we are going to circulate the PDF of Jonathan's presentation as well as the recording to each and every one, probably by Monday. Then you can reach out to Jonathan. So I know that you might have a lot of questions regarding your tax portfolio and scenario, but if you prefer to do it privately, we certainly respect that. So far, we have a lot of good discussion today and very general questions, but definitely we encourage you to reach out to Jonathan on your private situation. Thanks so much again, Jonathan, and thanks again, Simon, for all the time in preparing such a good and detailed presentation. I think many of us still need time to digest all this technical information you provided. And then I'm sure that many of my clients who attended today will be reaching out to you, after going through all the details. Thanks again. Thank you.
Thank you. Thank you.
Yeah, thank you, everyone. Yeah, have a good rest of the weekend.
Thank you.
Thank you. Bye.